Hi, and welcome to Biztech's Inside Trading Show. The show is all about trading, and every week we discuss what trading is all about and all the required habits to make you a successful trader. We also share trading ideas and themes to help you make money. As always, I have my co host with me, Phan Leung. He's the founder and CIO of Track Record Trading Academy. Now, V, welcome to the show.
Hey, it's good to be here, Brian. Let's talk about trading.
Now, well, we'll talk about trading, but for a start, as always, we start with a quote. And the quote is from Keynes today.
Yes. So when the facts change, he said, I changed my mind. What do you do? Right. This is widely attributed to Keynes, but there's some people who think that it's not from him. But whatever the case may be, it's still a very good quote for a trader who wants to be consistently successful. So it is especially relevant today because right now we are in an environment where even the U.S. Federal Reserve will need to change their minds as data evolves. So they have been on a hiking spree since last year. It was pretty much well telegraphed. It was pretty much well charted ahead of time that they were going to hike interest rates to very high levels that most people did not expect them to do. But now that we are here, they are now at a juncture where it's very much dependent on how data evolves. So if facts change, they will likely change their mind as well. So they are not really telling you anything about the future that we will not find out as the days progress from here.
Now, we've got to start out with obviously overnight, the Fed pulled the trigger and raised rates by 25 basis points.
Yes, and they did. So they did raise interest rates by 25 basis points. That was widely expected. So it's not a surprise to anybody. Market reaction was quite muted. They made a minor change to their statement. They changed economic activity has been expanding at a moderate pace versus modest pace in the June statement.
Okay, and that's
Not
again
exactly sure what that
very,
means.
very cryptic, right? I mean,
Yes.
what's the difference between modest pace and moderate pace?
Yeah, pretty much nothing, right? So I don't know why they bothered to change it, but I guess to show you that they're not falling asleep at the job. But that's the change that they made. And more importantly, they said they will continue to assess additional information and assess the implications for monetary policy going forward. So I think that's code for saying they are highly data dependent, and that's what they're going to do going forward. They will decide as more information arises. And also, the decision to hike was unanimous. And I guess that's also because it was fully priced by markets, so they didn't want to surprise the markets at all.
Now, then, basically, then V, how should what were the key things that perhaps were influencing their decisions?
Well, I think we can look towards what he said in his press conference. So in his press conference, uh, the Fed Chair Powell basically said that monetary policy is restrictive, and we are now in a zone where real interest rates, which is nominal interest rates minus inflation, is positive, and hence it is exerting downward pressure on economy and inflation. But they believe still, because inflation is above their 2% target, they did this hike, but the decision for September is not predetermined. So they are in September they could hike again, or they could remain where they are currently at, which is 5.2%, 5.25% to 5%. And if they do see inflation coming down credibly between now and then, they can move to a more neutral level or even a below neutral level at some point, right? So that means if inflation continues to fall, real interest rate will rise, and they may move, which is they may cut interest rates to ensure that no additional pressure, no additional downward pressure is exerted on the economy and inflation. So that's good, right? But also importantly, he acknowledged that hiking until we see inflation at 2% is a formula for going past the target, meaning that inflation could very well fall below 2%, and then they have to do more to bring it up to 2% again. So the risk of doing too much versus the risk of doing too little, not enough, is now quite balanced. And as such, they have not made any decisions about future meetings. and they also acknowledge that they will not give forward guidance, and they are ready to follow the data, and they can afford to be patient. So he did mention that they could pause a meeting or two, and he's not pre-committing to a hike every other meeting as well. Says it's all about the data as it evolves and as it's released in the months ahead. And more importantly, also is the staff economists from the Federal Reserve is now not expecting a recession later this year. They were previously predicting one, and I guess the reason for that is because we are seeing inflation moderating, but the labor market, the jobs market, remain resilient, and the economic growth remain quite modest, moderate, as I said. So that's a good result, because that means that the Fed do not have to continue to aggressively hike going forward now that inflation is on a downward trajectory.
Now, if you look at this, then from a year ago, we are basically at the level, pretty much the level that they said terminal rates were going to be at. And there is also then, as they've guided us to, Chairman Powell guided us to, is really the sense that they don't want to to overshoot their targets and are waiting for some of the lag effects to be seen more clearly before they act further.
Yes, so it's good that he is acknowledging that the full impact of the rate hikes are not yet fully felt, right? And in money policy will continue to be, right now it's restrictive. It will be more restrictive as inflation falls, because real interest rates, as a reminder, is nominal interest rates minus inflation. Current nominal interest rates, as they hike yesterday, is now 5.25%. So inflation as measured by the CPI headline is 3%. So we are seeing 2.25% effective real interest rates. And if inflation continues to drop without any action from the Fed, real interest rates will continue to rise. So that means they will be exerting more downward pressure on the economy. And as you said, they pretty much are at the level of terminal interest rates where they said they have been predicted at the earlier cycle of the interest rate hikes. And in June, they actually projected two more interest rate hikes before the cycle ends, right? So now we have already one, and the other
Yeah.
one is pretty much still up in the air, depending on the inflation data as we see going forward as well.
Okay, V, now, given all of this, we are regular investors. What do we need to do?
So we know that lagged impacts are not yet fully felt. We know that we are in restrictive zone. So it's very, very crucial to monitor inflation data going forward. So as we said as well at the beginning of this episode, we said that if the facts change, we must change our mind. But right now, I think the facts are pointing towards more moderate inflation, more disinflation. And the Fed is now acknowledging that they are in restrictive zone, and the risk of doing too much versus risk of doing too little is quite balanced. I believe the trend which we've been seeing, which is risk assets rising throughout this year, especially in the last few months, is likely to continue unless
Mhm.
we see an unexpected rise in inflation going forward. If we will see a new data point on inflation, which is the Fed's preferred measure of inflation, the PCE price index, on Friday. If that should come in as expected or below expectations, I believe the risk rally will continue. And if it's below expectations, it surprises people on the downside of inflation. We will likely see a renewed strength in the rally of risk assets across the board going forward as well.
And I want to bring us back to, I mean, just taking your cue here, bring us back to a couple of shows ago, V, where you outlined the fact that the early stages of a bull market are sometimes the signs are when you least expect it. And are you seeing some of that right now?
Yes, I think is exactly as you say. We spoke of this before. Bull markets are not when all the stars are aligned, right? Then we are already in the midst of a bull market, right? Bull market starts when all the negative factors are being ignored, or as they say in Wall Street, it is the markets climbing the wall of worry. So right now we still have a lot of worries. We have worries of recession at some quarters. Apparently, the Fed economists are not thinking of recession anymore, but we still see a lot of those the articles about recession in the press, and interest rates is quite high, and we are now in the restrictive zone, and the Fed continues to taper their balance sheet. They continue to cut their balance sheet and stop. They've not yet said that they're end of the hiking cycle, but that's how market is, right? It's always pricing in what information we have now and start predicting the future. And what we are seeing is that the AI boom continues, and the past week we are not seeing outperformance in tech stocks. We are seeing outperformance in the traditional stocks as well, right? Oil prices are rising because of expectations of demand from China, given that the Chinese government now is very focused on boosting the consumer economy, and the crackdown on the real estate and tech sectors is largely over, and pretty much over, given the statements that we have heard from them, and they're now very focused on boosting their economy in China. So I believe that what we are seeing is the initial signs of a more risk-friendly environment going forward. The risk to this view is inflation, right? If we do see a renewed spike in inflation, which some people are starting to worry, because we are seeing a rise in oil prices. They think that these oil prices will feed into higher inflation. But even with this rise in oil prices, it is still very much below the peaks that we saw last year. So that continues to be a disinflationary component in the inflation price index basket.
V, thanks a lot for your insights. Thanks for coming on the show.
It's good to be here. Let's talk again soon.
Now, that's it for this week's Inside Trading Show. We've been speaking to Phan Leung, the founder and CIO of Track Record Trading Academy, on Biztech's Inside Trading Show. I'm Brian Fernandez, and this interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.